welcome to today's episode of the Modern Sense podcast. I'm your host, Andrea Thompson. My guest today is David O'Leary, founder of Kind Wealth, who brings an incredible story of personal and financial transformation. Despite his prestigious credentials, including an MBA and a nearly completed CFA, David had a secret. He was bankrupt. In this episode, David opens up about his early career on Bay Street, the high-flying days of the 90s tech boom, and the decisions that led him to controlling nearly $500,000 in investments, most of it borrowed. But when the market collapsed, so did his portfolio, leading to the toughest decision of his life, declaring bankruptcy. David's story is one of redemption, resilience, and the lessons learned from financial failure. Today, he uses his experience to help others take control of their money and build a wealth management practice with integrity and social impact. Tune in as David shares his remarkable journey and the powerful financial wisdom that came out of his toughest moments. Hey, good morning and welcome, David O'Leary. I'm really excited to have you here today.
Thanks, Andrea. I'm excited to be chatting with you.
Perfect. Well, before we share your story, tell the audience a little bit more about you. You have a podcast as well, and the work that you do at Kind Wealth today. Would love to hear a little bit of background.
Sure, yeah. So, yes, I also host a podcast. Who doesn't these days, I guess? But I've been doing that for a number of years now, and it's on impact investing. So how do you make investments that make a measurable and intentional positive impact on the world? And so that's a whole kind of field that is growing and emerging and interesting. And so, yeah, that's how I spend part of my time. I also, as you mentioned, I founded and run Kind Wealth. And Kind Wealth is a advice-only financial planning operation, much like yours. Our target market and kind of who we serve and how we do it is a little bit different. But we essentially work with families who have created a lot of wealth and want financial guidance on how to fit all the pieces of their financial lives together in ways that allow their money to be there for them to achieve the life that they want. I know we share, I think very similar philosophies about this, and this would resonate with you, but we talk a lot about helping our clients not maximize their net worth, but to really maximize their, return on life, if you will, rather than return on investment, which is, how do I make sure that my wealth is allowing me to live the type of life that I want to, a life that is meaningful and rewarding and rich. And what does that even mean? What does that mean to me? A lot of people don't take the time to really stop and think about what would a life that was really meaningful look like, and not just, well, I do this because I have to, or we need the money, or because it's expected, or because that's just the default mode I'm in, which a lot of us are in. So that's a little bit about me and how I'm spending my time.
Fantastic. And you have quite the pedigree beyond Kind Wealth, and you come from a really interesting history in the financial sector. So I would love for you to spend just a few minutes talking about where you come from.
Sure. Yeah. I feel very lucky. I mean, the long story short, and we'll get into a little bit as I talk a little bit about my story, but I just started, working at a bank when I was in high school, and that I was thinking about being a teacher because I come from a family of teachers, and starting to learn about, the markets and finance and banking, just even as coming out of high school, going into universities, working at the bank as a teller was my kind of first foray. I started to get interested, and that led me down a path where I ultimately, went on to do an MBA and CFA, and I spent about 13, 14 years, maybe the first half of my career with Morningstar. And for those who don't know Morningstar, it's a global investment data and analytics provider. So they provide a lot of information and data, software products, and analysis to the industry on investments like mutual funds and ETFs and stocks and bonds and things like that. And I worked on a team that used a lot of the data and analytics that Morningstar produces to evaluate professional money managers. And so the people running the mutual funds and ETFs that you're paying to manage your money, how are they doing? Are they worth the fees that they're charging? Do we have any confidence they'll be able to outperform the markets? Not historically, just looking backwards, but in the future going forward. And we would write very kind of long, detailed reports on these mutual funds, telling the world what we thought of them. And I did a lot of public speaking in that role, the media around, because Morningstar didn't sell any investments, and recommend any. We were really just, here's our analysis of what's out there, and we're an objective third party that's helping you make sense of it. And so the media loved that, and they would often ask us a lot of questions. And I did a lot of public speaking, on newspapers and television about the problems in the industry that I saw around lack of transparency, particularly right when it comes to fees, and conflicts of interest that affect financial advisors and even the investment managers who are running funds. And Morningstar, I feel lucky because it was a place that really prioritized and valued independence and objectivity. And a lot of the industry I was criticizing are the customers of Morningstar. They buy the software and the analytics and the data that Morningstar puts out into the world. Yet they provided us with that sort of independence, and that, hey, we're not going to pressure them to say nice things. We're going to allow them to give their honest opinions about what they're seeing in the data and where the evidence is leading them. And that often led us to be pretty critical of the industry. And I feel really lucky that I sort of cut my teeth in the industry in a place that gave me that sort of independence and freedom. And it's shaped a lot who I am and what Kind Wealth is, and the decisions we made about how to set up Kind Wealth ultimately led to a very similar place you ended up, in terms of valuing those types of things so much that you leave the traditional industry to start your own practice in a much smaller sliver, the advice only sliver of the financial advice space. So yeah, that's a bit about my background. And then long story short, I basically left Morningstar to start a financial advisory practice. I really wanted to think about how do I bring some of these. There are these areas that are being neglected. I saw opportunities I'd spent some time traveling sub-Saharan Africa. My wife comes from a long line of humanitarian workers and missionaries who are giving their entire lives to making the world a better place. And I was thinking a lot more about how do I do that with my skill set in the industry that I've got all my education and experience. And so that kind of led me to leaving Morningstar, starting another financial advisory practice before Kind Wealth with some other partners to do a lot of things I wanted to do that I ultimately did with Kind Wealth, but couldn't do in that market. We just weren't on the same page about a lot of stuff. And I wanted to be pretty radical about how differently I set up this practice, and my previous partners weren't quite as aligned on that. So I left there and started Kind Wealth. And so that brings us back to Kind Wealth.
There we go. And it sounds like, the origin of your history with Morningstar is what led to your passion about impact investing. And then I think that really bleeds into the work that you do with Kind Wealth and with your clients as well. So that all comes together. That all makes sense. And I think we could probably have a whole podcast just talking about all of that because it
I'm
sounds
sure we
very, very interesting. But let's take it back a little bit further in time to the late 1990s where the story that we're going to discuss today begins. So what I would love to know is, where were you at as an 18-year-old in the 90s? What were your early investing days like? And how did you get started in investing?
Yeah, so I started working as a teller at Canada Trust back before when Canada Trust was a thing. Ultimately, it got bought by TD and was called TD Canada Trust for a while. And I think they've just been quietly dropping the Canada Trust stuff for a long time. So it's now just TD again. But Canada Trust was a really cool trust company rather than a bank. It was, I think, the largest trust company, or one of them anyway. And they were known for customer service. So they had their operating hours were 8 a.m. to 8 p.m. Monday through Friday, and then open on Saturdays as well. And so that beat all the banks, because I remember literally having to working part-time jobs where I would get a physical paycheck, and school would get out at 2:30, and I'd have to grab the very first bus that was leaving the school to be able to hope that I got off in time, run to the bank before the CIBC closed at 3 p.m. just to cash my check anyway. So Canada Trust was a really cool place. Worked as a teller, and then I had a friend who was really interested in the markets and stocks and all that. And so I was having lots of conversations with him, and then doing things like the Epic Mutual Funds course and some of the trainings at the bank, and learning little bits there and on my own, and make it very easy to open up an RRSP, right? Because you work at the bank, and your buddy over at the side counter can open up the account for you. And so that's how I kind of got into investing, was really just, I can save a bit of tax if I open up an RSP. And so started doing things like that.
And
That
how
was
old were
kind of
you at
really
the time Is this out of high school, during high school,
Yeah,
during university?
high school. So it would have been my final year. We were in grade 13 at that point. So I guess I was 18.
Yeah.
Yeah.
And good for you for, first of all, having the acumen at 18 to begin the investing journey, which I think is a rarity for the most part, from what I see. How much did you learn from high school for investing, or was it just everything that you learned externally?
Yeah, it was. I learned nothing in really in high school about it. I also just like, and I was up until I started working at the bank again, and my plan was just, oh, this is a good part-time job. I'm going to be a teacher. So I didn't
Hmm.
even really, I wasn't necessarily interested in that stuff, but the combination of a friend who was really into it and having lots of conversations with him, and then being at the bank and exposed to that world, I started to realize, oh, this is actually a lot more interesting than I thought, and started picking up, just doing a lot of reading on my own. But
Hmm.
as we'll talk about, I learned enough to be dangerous. I was reading news articles and books, not sort of academic books, but really stories about investors. So there's a lot of books in the 90s about the 1980s and the junk bond fiasco, and sort of books like Barbarians at the Gate and Den of Thieves. There's these novels and there's stories about what was going on in the world of finance
Hmm.
and the markets in the 1980s, which was a pretty crazy time, and the early 90s. But I wasn't learning like the the fundamental
Right.
theories and proper portfolio construction and risk management and diversification. Anyway, it was great in one way, and I don't regret anything, but it definitely led me into a place where I thought that I knew more than I did.
A little bit of the Wolf of Wall Street vibes, perhaps, at that time. Um,
Yeah,
yeah.
sure. Yeah.
And when you started investing, you mentioned mutual funds. Was that where you started? Was that your entry into investing? Did you carve out from there into stocks? What was that evolution like?
Yeah, that's right. So I started with mutual funds, and but I was, my friend who was kind of learning about a lot of this stuff himself and had started to invest in stocks himself, was where I started thinking about and getting more interested in. And then we were talking about, I remember literally the coffee shop we're sitting at, and he's talking about derivatives and how using what it means to have for options and futures. And you could literally buy a contract where, if you didn't sell the futures contract in time, you might end up with, a truck full of pork belly on your driveway, because they actually delivered the the commodity that you're trading these contracts on. And so that was wild to me, the leverage you could get and the types of leverage you could get on your gains and losses, if you got those calls right. And so that was exciting and interesting. And so that led me into, and the backdrop for this is that, this is 1998, 1999, where, sorry, it was probably even earlier. This is now, when I started, it would have been, 97, 98, I guess. And so this is like, we're late into the Bill Clinton administration, and it's been an amazing time, economically for the United States. The internet is a thing, and companies like Amazon and Google are, emerging for the first time. And anything and everything that had to do with the internet, the market was rewarding with very high valuations, even if there wasn't necessarily a sound business underneath. So the types of there were lots of tiny stocks out there that people were talking about, and the prices of these stocks were swinging, and for the most part going up only for the period when I started investing, where it just felt like you couldn't lose. Everybody
Hmm.
around you is talking about something that when you start watching that ticker and following it, you're like, look at this thing go up, and I'm going to do that. And so, and that was my experience, was nothing but, a lot of real positive gains on, even small, illiquid, risky stocks.
So you felt successful, I would assume. Did you believe your own hype, or did you recognize at the time that this was sort of market influence or influences outside your control?
Yeah, it's interesting. That's a great question, because I don't think it's always the case that, in my case, I didn't have the sense that I'm the smartest, greatest person alive, but I also didn't have a strong sense of just how extraordinary this period is, because I didn't have the historical context. I certainly knew it didn't seem like an awful market, but you can't really, even if you intellectually understand that, oh, it's been worse previously, you're still not sort of appreciating that, like, hey, I don't know how long this will last and how bad things can get. And so I was not necessarily high on myself, but I wasn't at all worried, thinking nearly enough about what could go wrong.
Sure. And you and I talked about this before, but I think everyone has a similar experience with their first bull market and where it feels like, oh, wow, investing is a little easier than I thought. And, even going back to recent times for people that, post COVID started investing, you heard about the Robinhood accounts in the US and, a lot of young people opening up accounts, not understanding how things worked and, leveraging up led to a lot of financial ruin and in some cases, a lot of mental health issues
Yes.
from individuals in the States. So it's definitely scary if you don't really understand the fundamentals, as you were saying earlier, to go through a time in which it can reinforce, feelings of, adequacy or that you're really good at something, but also create a landscape for potentially more harm, which is, where your story goes. So where did things evolve for you out of the early successes that you were having as an investor?
Yeah. So, understandably, I imagine from the outside, those early wins and having, the bit of money that I had invested in, RSPs and things like that and buying, starting to buy these stocks doing well led me to, okay, well, how can I get my hands on more money? Because, I can only amplify my gains further if I have more to invest. And, this time now I'm, working my way up through the bank, and I went from a teller to working on the side counter where, there's different terms for what you call that individual, but, you'd open up investment accounts for people, do mortgages, lines of credit, things like that. And so I knew how, how things worked at the bank and how lending worked and what opportunities there were. And at the time they had this program where they were, this again, the sign of the economic times, the height of a bull market and everything's going great. The bank had a program on where they were extending lines of credit, unsecured lines of credit to business account holders. And so as long as you had a business account and you had a clean credit history, they would send you an offer in the mail for a line of credit for up to 15,000. So there's no like application process. The computer automatically just did a very quick check of your credit score and then would issue this letter. I knew that. And so I said, okay, well, why can't I register a business and set up a business? There was no rule that employees couldn't take part in this. So I did that. I set up registered a sole proprietor business and went downtown and got that signed up and then opened the account. And, 2-3 weeks later, I got the letter in the mail saying you got a line of credit. And so I did that and took that 15,000 and put it in my investment accounts and invested it. So that was great. And then it didn't take long where I was like, well, what's stopping me from doing that again? And so I did it again numerous times over. So I think that I had something like 60K, after doing this, whatever number of times that was 15 divided by 60. And so then, but what happened then was, I was again learning about options and derivatives and, trading on margin, and I had a margin account. So I'm taking 60K of, well, maybe there was 10K of my own money, but then, 60K of borrowed money and investing that on margin, which means to effectively borrow against borrowed money. And then ultimately, ended up trading, naked options on top of that, which only further enhances your
My
leverage.
goodness.
Yeah, yeah. So I'm controlling something like $200,000-$300,000 worth of stocks and options contracts at the height of and right before a pop in the market.
My gosh. And I can imagine that seeing the success of, the leverage upon leverage, but also the successes of doing the very risky strategies that you were doing at the time only enhanced your desire to, continue down that path. Was there any moment in that journey that you said, or maybe you thought to yourself, maybe I should take some of my gains and pay down some of the debt that I owe, or did that not cross your mind at any point?
No, I didn't seriously think about it. I mean, I also, because I wasn't up dramatically at that point because I still had like this was an evolution over a period of time. And so this is very late in the process that I'm finally kind of getting to this point and making some investments that are now kind of waiting to pay off, to really experience those larger, the same percentage gains, but now on this much larger kind of amount. And
Right.
that's really when it kind of started to unravel. So I never really got to a place where I like had this huge amount of equity over and above the margin and the lines of credit and
Mm-hmm.
everything that I could really, I think, seriously contemplate that. Though I certainly didn't have in my head and mind at the time, I just got to get to this point and then I'm going to lower my risk. I was not thinking clearly about, the downside.
Right. And your friend that you mentioned who got you into this to begin with, were you both still talking about this at the time? Was
Yeah.
your friend doing similar types of strategies?
Yeah, for sure. And in his, situation and how much he had invested and all that, I didn't have all the kind of details and what, kind of how much leverage he took versus, how much he put into his and all that. But sure, yeah, we were going through that. And I had other friends too who were like, a lot of friends ended up working at the same bank. We got each other in jobs and things like that. And so while the others weren't necessarily leveraging up and using margin and all that, they were taking their own savings and investing a lot of the same stocks. So when the markets, eventually faltered, a lot of us were, feeling it, just me a lot more than than the other.
Right. Well, let's take that forward in time a little bit. What happened in the early 2000s? What changed for you? We were coming out of the tech boom, which we call it now. You had, quite a substantial portfolio, I think, at that time, with an equivalently large amount of debt. So take us through what happened next.
Yeah, so it felt like not long after I kind of really got, a lot of the capital that I had kind of amassed over time. It kind of came later in the process as I got the kind of next lines of credit and got those assets deployed. That within kind of 2-3 months, we started to see the signs of cracking in the internet bubble, where there were some days where there was a pullback in the markets, and then it would repeat past that, and then eventually we had this sort of bigger and more sustained bursting of that bubble. And I can't remember the exact months and years and all that, but this would have been in late 1999, early 2000 that this starts. And then what was interesting about this market meltdown as compared to most, at least in my lifetime, in recent history, is that it was actually pretty prolonged. It didn't. So the financial crisis in 2008 was a pretty short lived. It was a 3, 4, 5 month period. Well, really kind of a 3 month period of the down before kind of bottoming, and then it was only 2, 3 months later that we were actually, I think within 6 months, it had surpassed its old highs. It was scary for sure, but it was contained and pretty concentrated. This one, that market went through a period of like these sort of deflationary periods, and then it would settle for a little bit and maybe recover, and then another, the bottom would drop out again, and then it would kind of recover, and then so it was just this long period of, man, your stomach sinks. You got this huge pit in your stomach, and you're realizing, oh my God, I don't have enough, my equity in this stock is not more than the margin, than the margin that I owe on this. So I don't want to sell this stock. And so now I'm like, but I've got payments on the line of credits that are due. So, I'm shifting around and trying to figure out what am I selling to make these, payments, and, waiting for, following the stocks that I'm holding like daily. I'm, pressing refresh, and you're like, at work, and you're distracted, and you're wherever you are, you're distracted by it, and my mood and my feelings are going up and down with the market every day, right? Where when we have these periods where it starts to rebound, you're like, okay, maybe that was it, and then
Hmm.
so it's just this really torturous emotional period for, a year and a half, basically,
My
until
gosh.
it had completely bottomed out. And I was, at that point had realized that I didn't have enough to, if I liquidated everything, I would still be short, and I can't make all the payments. And so I ultimately realized, like, oh, well, this is it. I'm at a runway now, and what am I going to do? And started, looking into bankruptcy as an option.
Wow. I mean, you're right. The prolonged nature, I think, of that particular market collapse, if you want to call it that, I think is what makes it probably a little bit more painful historically, just to imagine that stretch of time to have to watch that continually happen. I can't imagine that must have been really challenging mentally for you at the time. Were you going through that on your own, or did you have support in place to turn to that you felt comfortable speaking to family or friends about this?
Yeah, I had a little bit of ability to, I could talk about it with friends who were going through, right? But they weren't, we weren't going through a lot of the details and they weren't as levered. And so the part of like, we're commiserating on the markets and they're upset, but it's not to the same degree. And I'm not talking
Right.
openly about, oh boy, I don't know if I'm going to be able to make it through this. So yeah,
Yeah.
a big part of what was so, terrifying about it all, well, I just sort of had to, quietly, I didn't have to, I decided to quietly, handle and deal with because, you're embarrassed and worried and nervous and, it's something that, and I'm Irish Catholic, right? So it's, you just bottle it all up and don't talk about it.
So that you experienced a lot of feelings of shame, and I'm sure blaming yourself for things that some of which was completely outside of your control, but I'm sure that there was a lot of hindsight reflection at that time. At what point did you make the decision to go down the route of declaring bankruptcy? Did you make that all on your own? Did you seek counsel before you did that? Or tell us that story if you don't mind.
Yeah, sure. Yeah. I mean, I started looking into how does it work and some of did the details around it. And then if my memory serves me right, at the time I'm, still living at home. I did an undergraduate, University of Toronto and live in Toronto. And so I was commuting to school and saving money that way. And so I remember, just saying, well, I should share this with my parents now because it's, I do want their feedback and it'll be nice to be able to talk to them about it. And, it's too big a thing to try to hide that from them. And so we had that conversation and I had already looked into bankruptcy and was pretty sure that it was the right thing to do and told them, what I had learned. And they're not, my mom's a teacher. My dad worked for the government and this wasn't their field of expertise, but they, they understood and they thought it made sense. And, I remember that, that day, that them sort of chatting about like, how's this even possible that the bank is giving so much, is lending so much money to effectively a 19-year-old kid, they were just really surprised it was even possible. Not that like,
Yeah.
you did nothing wrong and you're perfect. They weren't certainly we're not saying that, but I think they understood that how, you know, torn up I was about it all and how awful I felt. And so they didn't feel the need that they needed to, you know, lecture me at that point,
Sure.
but they did. And they weren't sort of blaming the banks, but they were just like, how is this even possible? Which I
Yeah.
actually think is a fair question.
It is a fair question. And what are your thoughts on the role that financial institutions have in contributing to this situation? Let's say, not just with yourself, but other young people who might have easy access to credit.
I think, I mean, not just, I think all companies in every industry have a responsibility for who uses their products and services and how they use them, and that they take, I think, reasonable, but even more than just reasonable effort to, go to, I think, concerted effort to be really intentional and careful about either putting in safeguards or, putting out educational material, whatever those things are. I think they have a great responsibility to do that. And I do think that a lot of companies in general, and including the banks and insurance companies in the financial services industry in Canada, don't do a particularly good job of it. And they should be held to a higher standard. Now, I recognize that my situation, I was an insider of the bank. I understood better how it all worked. And I'm a bit of an edge case given the uniqueness of my circumstances. Where I see that happening today, right now, right, and we saw was the gamification of investing with platforms like Robinhood in the U.S., where the friction and the difficulty in getting an investment account open and being able to trade on margin and get access to some of these really pretty potentially dangerous products is very the barriers and that friction are non-existent anymore. It was a lot harder when I had to go a lot more effort to do it back then. Now, and then you're getting rewarded, right, with these like rewards and the cues in the app that make you want to do more of that because you get the dings or the rewards or the prize or whatever it is that's like, setting off your dopamine spikes even further. So stuff like that, I think, is predatory. I think we need to be really, really vigilant against it.
Yeah, definitely. And I'm sure you've seen some of the stories that came out from, the 2022, 2023, I guess, timeframe. Would that have been more 2023? Sorry, 22 was bad. People had easy access to capital. Interest rates, I don't think had yet started to come up significantly. And there was a lot of uncertainty about how the tax system worked, especially in the US for people incurring gains and losses. So that led to a lot of, again, buyer beware, but uncertainty how to actually use these instruments or how to understand the ramifications of using the instruments. And that in itself is very dangerous. And, that I think, unfortunately, isn't something that, you're right, responsibility is being taken for. I'm hoping that there's going to be more post-secondary education around some, again, fundamentals, not trading, but fundamentals in money. But I think we have a long way to go before we're even close to getting everybody at a level where they feel that they can make, informed decisions around that. But let's take it back to your story for a minute. So you've now declared bankruptcy. What came out of that for you? What impact did that have on the next few years of your life, both from a personal and emotional standpoint and also from a financial standpoint?
Yeah. So it brought a lot of relief, but okay, there's a solution here and I'm going to go through this process. A lot of uncertainty and angst, at the beginning while I'm just sort of working, okay, what does this mean? What do I need to do? And so you kind of go through the process of, providing all the inventory of your remaining assets and liabilities, all the statements, and they kind of sort through it. My situation is pretty straightforward because all the accounts were with one institution and, all have statements for everything. So it was, easier in a lot of regards. But it basically became a situation where the debt gets wiped off, but now I know my credit score shows what called N1s across the board, which was like, he's been bankrupt. And it's funny, I up until I claimed bankruptcy, I hadn't had a single late payment because I was successfully moving all the payments around. So I went from basically like, he's got a perfect credit rating to, oh, he's bankrupt, which is an atypical, I think, pattern to see before bankruptcy. But, realizing, okay, so I can't get credit now. But, so I had that relief of this debt is gone and I've taken care of that. But now I'm at this point, because this played out over, the bankruptcy process takes a while. And I was already an undergrad by the time the market had bottomed. So by the time the bankruptcy was done and kind of all that was behind me, I was like now in doing a master's program and like an MBA. And then I was off like, did a summer job and then full-time job after that. So now I'm like into my career and I'm working on Bay Street and I'm working at Morningstar at the time. And I'm downtown and you're going on work trips where you got to book hotels and going out for lunches where sometimes we're paying for it. And they didn't give us all a company credit card. So you'd pay on your personal card and then you'd get reimbursed. And so there's like a lot of situations that were coming up where I didn't have a credit card. And it's a little weird that, and I tended to be the younger person in the room in a lot of the places that I was at, just because I had taken an early interest in finance and did an MBA very young. And so I came out and was kind of, oftentimes around, people who were, older. And so it was just very like, I felt like I couldn't just say, oh, I don't have a credit card. That would be weird without some sort of explanation for why.
Sure.
So I just had a lot of awkward events where I'd be like, we're booking a trip out, west to, go see some investment managers and, hey, can you put it on your card? I had some big, expenses come through on my personal card and I don't know if I got the room and yada, yada, yada. So just like making up a lot of excuses or, for lunch and, not being able to, take the bill on your credit card. So, I ended up, the first thing I ended up doing was there was a company called Home Trust. I think they're still around and they had a secured visa where if I gave them $500, they would hold that and then they'd give me a visa for $500. And that was a lifeline because now at least I've got a $500 credit card. I can't book big things, but I can book small things. And it allows you to start rebuilding credit history so that when the 7 years comes and that bankruptcy gets erased from your record, like it literally, no one can tell that you were previously bankrupt once that period passes. Now I've got a credit history from the day I started the home trust visa, and so you're rebuilding your credit from scratch. And I knew it would be good for that reason as well. So that was a real lifeline. But I didn't get that for I think a couple of years after 2 or 3 years after I'd gone bankrupt. I don't know why, if it wasn't available or if I just didn't know about it. But
Yeah. So that's like the early days of Visa debit, it sounds like, in a way, or prepaid
yeah,
Visa cards.
yeah,
Yeah.
that's right. Yeah.
Yeah, fair enough. Was there anything else that was impacted financially? Because you were younger, I'm assuming you weren't yet at a point where you were seeking a mortgage, which would not have been available to you. But was there anything else that potentially came out of that you wish that you could have had access to credit for?
I mean, for the mortgage, it did end up, it did push me a little back on when I otherwise
Mm-hmm.
would have. So for sure, that was an issue. And I also had an experience where I had another job opportunity and I had ended up interviewing for it and got kind of very far into the interview process, and they made me the offer for the job, and I ended up, I can't remember if I accepted or we just got to this final point where they were making the offer and they were doing some sort of history check as part of their due diligence. They're like the very last steps. And they discovered this, and, in a financial role where I don't know exactly why they care all that much, but
Mm-hmm.
they did. And they basically retracted the offer. In hindsight, I'm glad they did, because I don't think it would have been a good move to move there.
Mm-hmm.
But at the time, for sure, it was. And regardless, the point is it can have that type of impact.
Right.
And there are other things too around professional designations in the industry, right? Like especially on the investment side, where if you're getting licensed as an investment advisor, credit history is part of it as well. And
Sure.
so my previous advisory practice, I had started with a couple of buddies. I was looking to get licensed, and part of that process was me having to explain, a bankruptcy, even that had happened, many years prior.
Yeah. And I'm assuming when you had the job offer rescinded, that must have had an impact to your confidence and also where you went professionally beyond that. Do you think that was sort of a tipping point for you in your professional journey?
For me, it was a huge relief, because it wouldn't have been the right move. I was just kind of bored and frustrated at the time, and going to. I think the banks are great for a lot of things. I think I've got my criticisms of the banks as well, and they're really bad at a lot of things. But they are certainly not a place that I want to work.
Yeah.
So I'm glad that I didn't end up going, because this was a bank basically that I was talking to.
Right.
So
Got
I'm
it.
glad that I didn't do that. It didn't end up having and for me, I was far enough along through that process, and it was just like this old wound kind of just like being
Yeah.
reopened. Like, oh, I thought that I was done with that, and even still, it's having an impact on my life, because it wasn't that they saw it on my credit history. They asked, "Have you previously claimed bankruptcy?" And so I answered that honestly. So it was that type of thing. So it's just at that point, it was more just like a bit of opening up an old wound, but it was not. It didn't have a huge impact, but certainly could have, right?
Yeah.
If that was
What
my
would
dream
you
job, I would have felt very differently.
That's true. I'm curious, what would I mean, just from your perspective and going through what you've gone through on the bankruptcy side, what do you wish you would have known prior to declaring bankruptcy, or what do you think other people should know about it that they might not know at face value? So sort of lessons learned in going through that process.
Yeah, it's a great question. I'd say I've talked to some folks subsequently, actually, through the COVID pandemic. We were talking to a business owner specifically who was, because we had this sort of program where we're offering kind of free advice to people during COVID who were really struggling. And one of them was a business owner had come to me, and she ran a physical co-working space that
Hmm.
had daycare built into it for parents, low-cost daycare. Anyway, it was a really great initiative, and but obviously really impacted by COVID. Nobody wanted to go in anymore and not being allowed to. And she was basically in the position where she couldn't get out of this long-term lease, and they didn't have enough funds coming in to cover it, and she put a lot of her own money into it, and was basically, in a lot of debt that she couldn't get out of. And I said to her, like, hey, you should think about bankruptcy as an option. I'm not saying that's the right thing. That's a bigger discussion. But a lot of people, like, bankruptcy is like, oh, that's the end. It's all over. That's the last resort. I failed. I'm a loser, end game. And so that's not like an option that people think about as like, so what are my choices here? It's like, okay, there are no other choices. So bankruptcy, I guess I have to because it's the worst possible outcome. And I think that's wrong. The bankruptcy is intentionally a get out of jail, not free, but it's a get out of jail card that can help you escape from, a bad mistake, which, effectively is what I had at a young age. That doesn't make you pay for that for many, 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 many years afterwards, right? Like trying to get yourself out from it that you can't recover. And it, it really is for me, uh, an amazing solution because it was a mistake. I learned my lesson. It wasn't free, as I say, you get a jail free card because the emotional angst, then like emotional penalty I paid for all that was, I would not choose to go through that again. Wanted to avoid that. And it has deeply and fundamentally shifted how I view risk
Hmm.
in very positive ways. But it allowed me to recover in a way that I couldn't if bankruptcy wasn't an option. So I encourage people to put it on the table as one of the options and really look into it before dismissing it as, oh, that's what you do when you've completely failed.
Okay, so moving on from the bankruptcy itself, and we've talked now about what's come out of the bankruptcy, what the next few years were like for you. How did that make you a better financial professional? How do you use your experience in helping you guide your clients that you have today?
Yeah. It's made me a much, much better advisor and investment professional. I have more, um, a much deeper understanding of risk and risk management, of what could go wrong. At that time, I was not. I was talking, about how I, lacked a good understanding of risk and proper risk management techniques, which is true. But I wasn't completely negligent either. So I was employing different strategy as I was reading about, and I'll give you one example because it sticks out in my mind so clearly. One of them was the dogs of the Dow strategy, which is this idea that the Dow is the 30, not 30 biggest, but 30 representative stocks of the US economy. And they typically are, though, very large, stable stalwarts. And the idea was buy the ones that have done the worst because, hey, they're not going anywhere.
Hmm.
These companies are solid. It's only a matter of time before they rebound. And I remember buying Bethlehem Steel because it was, had done so terribly, and it eventually went bankrupt. And so I was like, oh, right. Okay. So even the biggest companies who've been around for, 100 years or more can disappear.
Yeah.
And that fundamentally shaped my understanding of risk. And it also helps me understand, individuals, investor psychology. Not that everybody's experience will be my experience, but
Hmm.
I at least have an appreciation for, what those emotions can look and feel like, and the shame and embarrassment. Also understanding that, like, saying your risk tolerance is one thing and what it actually is when the shit hits the proverbial fan are two different things. And so a lot of the times, you'll be trying to assess a client's risk tolerance, and you'll use maybe some questionnaires and a combination of some conversations, and they'll be saying things like, oh yeah, no, it's okay. We're comfortable with higher risk. And say, okay, what does that mean? And wait a minute, what have you experienced before? And what did you do? So like I dig a lot more into that than I
Hmm.
would have if I didn't go through that experience
Yeah.
personally.
I think a lot of people are happy taking the upside risk, but the downside risk, if they haven't experienced it before, perhaps is a little bit of a nebulous concept, certainly. So I understand that. Going back to your comment, funnily enough, about dogs of the Dow, I think there's actually an ETF now that you can buy that it's called Dogs of the Dow. Are you familiar with that
I'm
ETF?
not, but it wouldn't
Okay.
surprise me. There's an ETF for everything.
Yeah,
And
there's
it
an
may
ETF.
not even be, a terrible strategy. I think the Dow increasingly there's just questions about how useful it is as an index anymore. But the idea of buying some of the worst performers is not necessarily a new concept, and probably not terrible compared to a lot of the other strategies out there you could be employing. Like, for me, it's a lot of day trading and trying to look at technicals. I kind of equate that to tea leaves and
Yeah.
astronomy, or astrology.
No, fair enough. I was just asking that more just because I came across that recently.
Interesting. I gotta look
Yeah,
at it.
there's so many different products out there. How do you help clients assess that risk when, because you often talk about impact investing and guiding people along their asset allocation journey, but how do you frame risk based on what you've gone through yourself for clients? Like, how does that help you in that conversation?
Yeah, I mean, I talk a lot about, listen, we want to plan for the best and hope for the best, but we also want to prepare for the worst. And so my question always, so my fundamental shift in my risk management, my views on risk management now are, and if whether it's financial or physical risk or any other type of risk we might be talking about, is always, okay, so I'm going to hope for and assume the best, but I am 100% prepared for the worst. Like, if the
Hmm.
worst happens, what will I do, and what will that mean to me? And if I can't accept that, then I have to do something different. I have to protect against that. And so that's this, like, hope for the best, expect the worst, is a mindset that I try to bring. And so I'll say that to clients. Like, hey, it's fine that you think that you're good with this risk. Maybe you are, but if you lost, if your portfolio dropped by 50% or 70% or whatever amount was appropriate for the risk level we're talking about, regardless of how likely that is, I want to know, what is that going to mean for you and your finances? Are you going to be able to, is that going to compromise your ability to pay your rent? If so,
Hmm.
then it's inappropriate. We need to think differently about this, or we need to protect against this somehow. So I'll really dive in there. I don't know if you want to go down this rabbit hole
Hmm.
or not at all, but you were mentioning about, investment products and, DAGs to the Dow strategy. And there is certainly a proliferation of all sorts of investment product in the world, that I think most of which, this kind of gets back a little bit to, Morningstar and what they're all about. There is a really great saying that Don Phillips, who was one of the earliest analysts at Morningstar and a managing director at the time, would say is, we would look at companies, and when we were evaluating a mutual fund, for instance, which is just, one type of investment product, a pretty plain vanilla one, but we would evaluate the company. We'd evaluate obviously things like the track record, the performance, the risk, the fees, all the things you'd think about, but also what we call the stewardship of the company that offered the mutual fund. So what is that company about? What's their story? What's their deal? Who are they? How do they, what types of products do they create? Who are their staff? How do they price their products? Not just this fund I'm analyzing, but the rest of them. They have a lot of retained staff. There's a lot of turnover there. What's their regulatory history? Have they been, slapped in the wrist by regulators before? Are they
Hmm.
in good standing? All these things. And one of the things that you look at is, what types of products do they choose to launch? We find is that firms were either very sales oriented or stewardship oriented. And a sales oriented firm will, you can imagine the, executives around the table thinking about the next product to launch, and they'll ask themselves, if we create this product, can we sell it?
Hmm.
And a firm that is focused on stewardship, having that same conversation, looks at this as, if we offer this type of product, what are our clients going to think of us 7-10 years down the line? And it's a very different mindset, right?
Paradigm.
What you see right now is, and it's, I think, typical in just capitalism, is not just in financial services, is, can we sell it? And let's, if we can sell it, then if somebody wants to buy it, who are we to say they shouldn't have it? That is a view that I think a lot of firms and companies and people hold. I personally disagree with it. And, I think, be greedy, and you should want to grow and want to do well financially, but the long-term success will come from treating people well and doing the right thing. And, if there's a high potential for abuse for a typical product, like, take even Robinhood, this conversation we were having about gamification. It's not an investment product. That's now a platform design decision, but same principle relies, which is, we can do this and it's going to up our trading activity and we're going to make more money in the short term. But what's it going to do to our long-term success when people ultimately end up blowing themselves up
Yep, for sure.
and aren't clients anymore?
Well, and going back to your point about products and how that ties into your leverage story as well, some of the, I think, non-understanding of individuals using these products that were created as a sales tool can lead to that same type of outcome. There's a lot of, double levered, triple levered, reverse bull bear ETFs that are incredibly complex instruments and really don't make people money if you look at what's actually going on. And these things are very dangerous tools that in the wrong hands can certainly lead someone to financial ruin. And I think there is a responsibility of the companies to, if they're going to offer these types of products, my goodness, there has to be some sort of responsibility to the consumer to educate them in some way, shape, or form, or to have, like a prospectus or something that they are mandated to understand. Scary when you see individuals, looking at this and just saying, well, look at the yield, or, look what it can do. And it's like, you don't even understand the thing that you're buying. So, I think that type of lack of awareness on, what the product is designed to do, like you said, is it designed to be a sales tool, or is it designed from a stewardship perspective? And how are you using that in your financial picture, and why are things that people need to consider before they start to enter into that crazy world, which is something
100%.
that I
If I
wish.
could just offer a
Yeah.
quick example, two brief ones. So I remember back at Morningstar, there was a large, talking to a fund manager at a large Canadian balanced mutual fund. And these were new, these levered ETFs at the time. This would have been in like the mid 2000s, I think, that was having this conversation. And we were just learning about them ourselves as the analyst team at Morningstar, trying to figure them out. And like, okay, I see they give you leverage. And as we had started working our way through these things and trying to understand them, we came to realize the nature of the way that they are designed them. They're meant to reflect the performance on any single given, of the performance on that given day of the market. To give you 2 times levered or 3 times levered or inverse levered, return day by day, but they have to keep adjusting the underlying derivatives that they're using to create this leverage, such that they can do it on a day-to-day basis. But the longer you extend your holding of that fund for, it's basically, long story short, is it's costing you money. Like you are systematically losing money. It's declining in value if you hold it beyond kind of a week, 2 weeks. And people didn't realize that. And we were talking to a fund manager at a large Canadian balance fund who owned one of these levered ETFs in the portfolio. It wasn't a huge position. I think it was a gold, kind of a hedge, and had a gold exposure. But the manager, it had been in the portfolio for like a year and a half, or over a year. And we were talking to them about it and realized that they didn't know that was the case with these. And we had only just figured it out ourselves. But it's a really good example of the more complexity there is in these financial products. You really have to understand what's happening, because you can get yourself into a lot of trouble. And those are a really good example of, I think those are very dangerous products that are technical tools that only professionals should have access to. If we're going to keep private equity for only accredited investors, those should definitely belong to that category. There's just no excuse for why an individual retail, non-professional investor should have access to those really dangerous tools. And these types of decisions about the complexity of products happen in even less, sensational or aggressive investment products. Just one quick other small example. There was a lot of these structured products where you have guarantees built into them, and they use some sort of financial alchemy to try to, protect you against the downside. A lot of times there's not all that much magic. So remember there were, I think it was BMO, but I don't want to pick on BMO because I think all the banks and a lot of the big providers are guilty of these types of things. But it was one of the banks it was a fund of funds, and they, guaranteed, kind of, you couldn't lose any money and you're going to get at least X% return per year. But it's and it could do more. If the markets did better, you get more.
Sure.
And what buried in the fine print, and again, most people didn't realize until it happened. We actually didn't know either. The markets collapsed. If the market fell by more than, it says, if the underlying assets in the fund fell by more than, like, can't remember what the number is, 40% or 30%, they would actually just sell all the underlying assets and they're going to give you your principal back, but now you're just locked in until the end of the contract because you had to buy these things for 10 years or something like that.
Right. Yeah.
And so somewhere in the neighborhood of like 5 years into these, the markets fell out. They sold off all the underlying assets to stop the bleeding, the losses.
Mm-hmm.
They promise you're going to get your principal back, but 5 years from now. So you'll have gone
Right.
10 years and made nothing. And that was a good example of people go, "Look, I'm going to get at least this much. I'm probably going to get my, at least my 5%. My principal is guaranteed and they're promising me 5% or more.
Mm-hmm.
And here we go. And you've like, great, I got my capital back, but 10 years of lost gains is a huge cost that just people didn't realize. So I'm a big proponent with people now of like simplicity in a lot of ways. And if I don't understand a product really well, if you can't explain it to me, then I'm not investing in it because I don't need to. We can stick with simple, safe things that are going to do the job.
For sure. And I think just sort of stemming back to this conversation about bankruptcy, but also in the way in which the individual today, the DIY investor of today, has much more individual responsibility in their financial situation to do all of the research, to make all the decisions, and really to take on the emotional burden of being their own portfolio manager. What would you say to those individuals as sort of I'm coming to you from the future? What would you want them to know to not just avoid making mistakes, but avoid getting themselves into a place where they may have to consider looking at something like bankruptcy?
Yeah. So I tell all of our clients, and a lot of our clients, again, are very, very wealthy families who often there's this thought in the world that like, oh, if you're really, really wealthy, you've got access to all these fancy investment opportunities that ordinary folks don't. And there is some truth to that. There are investment opportunities that they'll have. But most of those investment opportunities are really, again, just products that have been manufactured, engineered to sell a good story and do the same thing that's happening to individuals who buy, ordinary folks who buy these levered ETFs to very wealthy individuals who the shtick is and the marketing pitch is, because this is elite, this is something that only you get. And so everybody loves that feeling of I get something that other people don't have access to. I'm special. Even if we don't consciously admit it, it feels good internally. And the industry knows that. And it's essentially usually just a way to charge higher prices for something that they don't need. So my advice to everybody is keep things simple. If you're DIYing, it's okay to DIY. I encourage people to DIY if you have an interest in it. But what I'd say is it doesn't have to be all or nothing. So if you haven't done it before, I would say start with, an approach where, an online investment provider, robo-advisor is a good place to start. If you're looking to keep your fees low, get invested and not really, a bit of training wheels, you maybe have to buy, you can have your portfolio kind of managed for you there. Then take a portion of your portfolio and DIY it. Even then, my advice is don't bother with individual stocks and bonds. Don't bother with hedge funds or anything fancy. You buy some plain indexes on the major markets, or just buy an asset allocation ETF, which is, as you know, one ETF that owns a bunch of these. And do that if you're really in. So like that's a way where you could manage your whole portfolio DIY because it's kind of high. It's kind of like, yeah, I got to buy those ETFs, but once I do that, they're managed for me. So it's kind of not really DIY, but it keeps your costs really low. And if you still are like, no, I love to buy some individual stocks and bonds or whatever, like more, it's not just going to be a buy and hold. I want to do some trading and I want to do some research. Then just take a small portion of your portfolio, because even if you're successful for a period of time, you can look really, really smart for a long time until you're not. And then, if you're not properly practicing risk management, that's when you get into a lot of trouble. So I don't even say things like, well, if it goes well for 2-3 years, then you should, and then you can take more and more and put it, because it can go well for 5, 7, 10 years before things turn on you. So I don't encourage anybody, unless they're really going to like educate themselves on the fundamentals of portfolio management, investment management, and do the academic exercise of understanding how you build the portfolio and what proper risk management looks like. If you are going to do that, great. then over time you can eventually take over managing your portfolio and buy a bunch of stocks and do the proper diversification. But there's such a small percentage of the population that would do that and be able to want to do that and be able to do that confidently. So overwhelmingly, I say keep it simple, passive, buy an asset allocation ETF or use an online provider. And if you want to take some play money, go for it. That's cool. I think it's great. It's good learning. You're going to gain the experiences of seeing how you react to the volatility of owning individual stocks that may be swinging more wildly than a diversified ETF does. Like that's all placing trades, what's a buy, what's a sell limit, and what is a bid ask, spread, and like all those things are great. It's empowering.
Mm-hmm.
Just
For
don't
sure.
think that that's the way you're going to do better than, get to achieve your financial goals.
Yeah, I think the overriding message that I think is very important for DIY investors, which is very commonplace. Investing is not gambling. Gambling is not investing. These are two mutually exclusive things. And I think sometimes the thrill that we get when we have a success that we can see, usually more so when we buy individual securities, can lead us to that bias towards buying more individual securities and seeing that quick payoff, that quick hit that we get in this society that we're in now, in which we have a lot of instantaneous gratification. We get things at our fingertips. And I think especially for the youth of today, we're used to getting things so quickly that the patience of being a long-term investor is not something easily taught. So I think that messaging is really important. And you and I, I'm sure, both have many client stories that we can point to where not just in that case, but also the emotion of maybe not having achieved a certain goal that you want to leads you into more of that gambling mentality where you are taking away the risk management aspect and really just trying to achieve something more quickly because you haven't done enough, perhaps historically, where you feel like you should have. So there is a lot of blame, shame, hindsight, I should have, I would have, which I'm sure comes alongside many people's financial stories. That is important, I think, to highlight is just recognizing, your own emotional biases in your situation and how that's leading into your investing journey and taking, leverage risks perhaps, or buying securities that can lead you to potential financial ruin.
And I would just add, if you are just because you are buying stocks or you're buying ETFs through a trading account doesn't mean you're investing. That very much could be gambling. And the way is, hey, I have a thoughtful, disciplined risk management process. And like I had a process for how I constructed my portfolio. If that is like, oh, I don't know what that means, then you're gambling because you're just buying a bunch of individual investments is not how professional investors. Portfolio construction is a whole part of the
Exactly.
process, and the sum of the parts is greater than the individual pieces. And so if you don't know what those techniques are, that's a good indication that your investing is actually gambling because
Yeah,
it's just,
for sure.
there's not a process behind it.
So, sort of to wrap all of this up, what advice would you give to either a young investor? It could be also a seasoned individual who wants to, begin their financial journey or are feeling overwhelmed by beginning a financial journey and doesn't know where to start.
Yeah, I'd start with get some money into an account. A great place to start are online investment providers or discount brokerage if you want. And you can, if that's, some people have different levels of comfort with trying something like, placing a trade on an ETF, even if we're going to talk about like an asset allocation ETF, which would, be like a Vanguard or BlackRock where you buy the one ETF and it gives you that exposure. But either one of those two options, get your money invested into a diversified portfolio of probably stocks. If you're young, you don't probably need a lot of bonds, if any, and let the compounding work. And this is really boring, right? It's just point you were making. It's human nature. We want things now and quickly and instant gratification and instant results. But this is very much like going to the gym and exercise and healthy eating. Like you just have to do it over and over and over again. And there's no shortcut to just miracle overnight results. And investing is the same. My message to the young person with $5,000 is the same as the message to the client with $100 million. I'm not even kidding. The vast majority of the stuff they're investing in is just not worth, like, they're not getting a good deal. But like, after you look at the returns after the costs and after the hassle that's involved with some of these opportunities, it's just not worth it. So stick to the basics, keep things simple, and the results come from compounding over a long period of time. You're not going to make it up with, I found this magic solution, this magic investment, the secret thing, or this opportunity that nobody else knew about, and it led me to such great returns that I made up, I made up a lost ground, or I made up for my mistakes, or I got way ahead at a young age. Like, those don't exist. If it does happen, it's coincidence and luck, and it could easily have gone the other way.
Yeah, those are the lottery ticket stories for
That's right.
sure.
Yeah.
Yeah. So lastly, let's just talk about your final words on the use of leverage or the use of margin. Is there any case in which you see that being beneficial, or who are the people that you think are suitable candidates for that type of
Yeah. So listen, leverage is absolutely necessary and for all of us in a very, very big way, right? Our real estate, most of us can't buy a home unless we borrow, and that very much is leverage. Outside of that, I don't think there's a need for leverage. Are there some edge cases, and are there certain types of people that will benefit from it and can use it responsibly? Sure. But on the whole, I think it just does a lot more damage than it does good for most people. And so there's not been a time that I would recommend it. I could see I'll give you some examples, right? Like, banks will offer an RSP loan. So they give you a loan to contribute to your RSP for the deadline so you can get the tax break. And sure, there's some temporary period where you're taking advantage of something like that. Sure. But I don't think that's what most people are talking about when they talk about taking some leverage and borrowing, either on using margin or taking borrowed money to put into the markets. It amplifies what's already a pretty volatile asset class if we're talking about stocks, and makes it even more volatile. And I don't think volatility is our friend. There's some really good data on the most volatile funds tend to be used the least effectively. Like, people, they're buying it after it's already gone up high, and they're selling it after it's dropped in value. So what they're experiencing is, essentially they're not getting the returns that the fund is publishing because of their bad timing on, like, when they're buying and selling it. And the more volatile the asset class is, it just makes us more prone to fear and greed based decisions, which are usually suboptimal.
Yeah, emotional investing in a way, and don't buy Nvidia on margin. That's
Yes.
what you're saying.
Yeah. That's
In
a
a
pretty
nutshell.
safe bet.
Pretty safe bet. Well, David,
Yeah.
I really appreciate your story today, sharing your story with the public and all of your really insightful thoughts. I really respect what you're doing and what you're putting out there. Any last words from you? Anything else that you'd like our listeners to know?
Well, thank you. I also have a lot of respect for what you're doing at Modern Sense. And, this industry is pretty small, the advice-only planners. And so you've been a really great addition to that, community. So I love what you're doing and share a lot of, thoughts and views with you on the industry and all of that. No, I would say just, this is what I tell everybody is, if I could have Canadians know one thing, like, just snap my fingers, there was only one thing I could make sure they knew regards to their finances, it would be the distinction between investment management and financial planning. And most people are looking to investments to solve their financial problems and questions because they don't have any clarity about what their goals are and if they've got enough to achieve them and what they can be doing to make sure they're on track if they're not, and they don't even know if they are. And so the assumption is like, well, I got to just get the best returns I can and hope for the best. And financial planning is an entirely separate, I know you know all this, but for people listening, is entirely separate discipline and profession that has very little overlap with investment management. And because I was a CFA charter holder and I was in the investment world, I thought that I know about finance. Financial planning is just financial advice. Like, no, it's an entirely separate profession with its own body of knowledge
Yeah.
and continuing education requirements and standards. And that process is what most people actually need. And they don't know that that's out there and that there are people who provide that. And so once you start to get some clarity and then you've got some strategies for, how to optimize things, you realize that's where I'm going to make up the money that I need and to reach my goals and get some clarity and confidence about that. And I don't need to stretch for every extra percentage I can get and chase every fancy investment, because I've got the confidence that I've got a plan in place, and I've seen projections that show me I'm going to be okay even if I get this sort of modest return, I'll be okay. It takes all that pressure off of searching for that next investment and allows you to simplify that, buy and hold, forget about it, focus on the tax planning and all the other things that are going to, move the needle a lot more predictably than hoping for the best in the markets with some, exotic investment option.
Or leverage or margin. Yes,
Yeah,
preach. All of what you
100%.
said, all of that. And where can people find you, David?
So our website is kindwealth.ca. I've got an impact investing podcast, davidoleary.ca. Yeah, davidoleary.ca. But if you just Google the impact investing podcast or kindwealth.ca, and you'll find me. I'm pretty easy to find.
And well, thank you so much for sharing. Much appreciated. And thanks everyone today for listening.
Thanks, Andrea.